Gargi, I guess the big question is the kickoff to earnings season. We saw last week with a couple of the big banks providing some relatively encouraging numbers and commentary. Do you expect to hear that same type of optimism out of other CEOs and CFOs as we get deeper into this earnings season?
Good afternoon. It's so great to be here. Thank you so much for having me. I think that's exactly the right question. See, coming into this earnings season, I think one thing that we have to appreciate is how much earnings growth expectations were revised lower. So the first thing that I'm watching for is to see to what extent the beats continue to be both on the top level and on revenues and on earnings. So that's one thing. The second thing that I'm hoping to see through the course of earnings seasons is this optimism around the consumer. So we saw a little bit of that, obviously, as we heard from some of the larger banks. I want to see to what extent that continues. And then the third thing that I think will be important for all of us in the markets is just any kind of commentary around what is going on as companies, CFOs, CEOs are thinking about their labor force. To what extent are they thinking about layoffs, if that's something at all that's coming up? And to what extent do lower interest rates make a difference to their CapEx plans, et cetera? So that's what I'm looking for with the eye on broadening earnings across 8 to 9 different sectors of the S&P as opposed to just a few that we had seen coming into this year.
So you have some optimism that when we get to this end of this earnings season and we have you back on to talk about what happened, we will be able to have a conversation that is much broader than just the Mag 7 and some of those big tech stocks.
Hope so. And I think we're already sort of beginning to see that, or at least we're beginning to see that in what the market is pricing in for earnings growth. We're beginning to see that earnings growth between Mag 7 and the rest of the 493. We're beginning to see that compress a little bit, not just for this season, but for next season as well. We're beginning to see earnings growth in healthcare, in utilities, obviously in the tech and tech plus. And I think we just have to see that continue through the end of this season and, point positively in terms of guidance for next quarter as well.
But, if you take a look at the broader index level, communication services and tech are like 40% of the S&P. So the broader index is going to have a hard time moving higher if Mag 7 don't deliver. Is 18% earnings growth going to be good enough?
You know, I think there's a slight nuance here. It's not about the broader tech and communication services, tech plus, underperforming. It's about everything else moving up. And I think that's what we're expecting. And, you know, we point out in our fall investment directions that we just came out with at the end of last month around how this is a time to not just think about moving away from tech. It's not that at all. We think that tech and quality should be the backbone and the core of your portfolio. But it is thinking about some of these other areas that might have been forgotten for such a long time that are beginning to show some life in August, September, and certainly expected to do so for the rest of the year.
Something I keep pointing out is that mid-cap index doing really well and record high after record high along with the S&P, while the Russell 2000 is kind of lagging. How does SMIDS fit into that allocation?
Yeah, so one of the things that we've talked about and with you before, Alex, and in other shows as well in our research is that despite the cutting cycle that has begun and despite economic growth that continues to be pretty robust as of right now, the expectation of small caps to actually vastly outperform large cap is not what we have at the moment. We still think that large cap, and especially right now, we think rotating to large cap value might be a better place for investors. I think we need to see meaningfully lower rates make its way into balance sheet strength for these small cap companies that can then have earnings growth. We need to see that, and we haven't. So I think it's going to be hard for small caps to outperform. And again, this is about the relative performance between the two, not absolute. It's going to be hard to see that outperformance of small cap space.
Do you think, though, and I get that here, if we do get more meaningful cuts, meaning we get that series of cuts that the market is priced in here, and I know there's a lag and all that, blah, 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 but once we get to that, Gargi, do you start to see a more meaningful impact on the bottom line for those companies?
I think we have to begin to see those cuts, and at the same time, economic growth needs to not just be strong, but it needs to be accelerating. So it's not enough to have economic growth as measured by real GDP or other measures, not just enough for it to not be in recessionary levels. We need to actually have an expectation that from here on, economic growth is accelerating at the same time as rates are moving lower, and all of that then manifests itself in many of these small cap companies being able to have stronger profitability, be able to have stronger earnings growth. Yeah. Obviously, we know this number, but about 40% of some of the small cap indices have negative earnings growth. They're not quite profitable yet. So if all of those things take place, yes, absolutely. I'd love to come here and talk to you about IWM and the opportunity it presents. But for right now, not quite yet.